you have to pay capital gains tax on your home. Now, generally, you don't pay capital gains tax if you sell the home you live in, under the main residence exemption. And in return, you can't claim income tax deductions for the costs associated with buying or selling your home or running your home. But sometimes things change. You sometimes rent out your home for a while, you subdivide the property, you build a granny flat, you move out, you move back. What does all this mean for capital gains tax obligations? Interestingly, this is a very, very common question asked of tax strategist Ken Race. So I thought I'd ask him your questions directly. So let's have a quick chat with Australia's leading tax strategist, Ken Race, Director of Metropole Wealth Advisory. Welcome, Ken.
Hi, Michael.
So Ken, let's start with the simple question. What is capital gains tax?
So it's a tax that is applied to the increased value of your assets. So capital gains tax was introduced in 1985. And from that point on, any increase in the value of those assets is taxable. The tax is applied to you as normal income. So that capital gain is added to your normal income. But if you've held that asset for more than 12 months, then there's a 50% reduction in the tax that you would have otherwise paid. So it's a tax on the increased value of your investments.
Now, of course, it only happens when you crystallize the profit, when you sell the property. So for lots of long-term investors, that's not an issue. But for your home, your principal place of residence, there's no capital gains tax involved. But as I said a minute ago, sometimes things change. So what are the capital gains tax implications if I subdivide my home and sell off part of the property, Ken?
So maybe if we go back to the beginning, if you occupy a property and use it as your home, those capital gains are tax-free on the sale. But what they look at is the land area that is being occupied as opposed to the building. And they only apply the exemption to that component of the land where the building sits that you used as your home. So if you subdivide and sell, call it the back part of your land, that was not needed for your home because you subdivided and you sold it. So that capital gain will be fully taxable. And they go back to calculate that gain from the purchase price that you made maybe 10, 15, 20 years ago. So they'll go back and say, what did you pay for that land when you first bought it? What is the value of the building? To then leave a residual for the land and then apportion that value to the land that you're selling. So for most people, the cost of that land is quite small, given that development might be many, many years after purchase.
Interesting. So there's a little trap there when people think, oh, I can just sell off part of my home. It may cost them a bit more than they thought.
And normally when I speak to clients, that is a surprisingly large number because in the majority of cases, people are doing the subdivision 20 years later. So they paid tens of thousands of dollars for the land, and they're now selling it for many hundreds of thousands. So that gap is fully taxable.
Ken, we're talking about when capital gains tax could apply to your home, to your principal place of residence. And what happens if I have a tenant in my property at the time I purchase it? In other words, there's a tenant for a while and then I move in sometime later.
And we find that often happens. You buy a property, there's a tenant in there, and you wait for that lease to expire. So you didn't buy it as vacant possession. So that means you didn't occupy that property from the date of settlement. So that means you owned it for a period of time as an investment property. And under those circumstances, the eventual sale of that family home will have a capital gain that is taxable. And that'll be proportionate to the number of days you had a tenant in it at the beginning to the total ownership period. So if you had somebody in there for 6 months and you owned it for 10 years, then 6 months out of 10.5 years would be taxable. A
Now,
completely different scenario if you'd moved in first and then subsequently had a tenant.
well, that happens very often, Ken. So explain to me what happens if I move in to my home and then after a while I decide to go away, go overseas, move somewhere else and lease out my home.
So when you move out, now that becomes an investment property. So at that point in time, if you don't own another home, then that capital growth over the next 6 years is still tax-free. There's a 6-year absent rule. If you purchase another home and use it as your family home, then when you sell either one of those two, you've got to identify to the taxman which one you want to use for the main residence exemption. And what most people do is they calculate what the capital gain has been and likely to be in the future to then tell the taxman, this is the home I'll use for tax purposes. And it's normally the one that's had, can I say, the highest capital gain because they want that as free.
Now, I know a question that's often left on Property Update on the articles about capital gains tax is, okay, my 6 years is up. How long do I have to go back inside there for a while to get another 6-year exemption?
So that's similar question to how long do I have to live in it when I move in having just bought it? And there is no legislative time limit. All the legislation says is you must occupy and use the property as your home. So literally 1 day. But the shorter that period, the more likely you are to get a question from the ATO. Did you only just move in there for a short period of time to contrive a tax-free benefit, i.e. is it part of a tax avoidance scheme? But many people, for very legitimate reasons, spend a very short period of time in the home. They've lost their job, you know, the week that they've bought the property. Interest rates start to skyrocket. They have family illnesses. So there's many legitimate reasons that could force somebody out of that home in what would otherwise be a short period of time. So keep track of that reason, document it for when you need to use it to explain to the taxman.
In the other way, if it's 6 years that I've had a tenant there and I sell it 7 years later, I assume it's again a proportion of the period of time of the capital gains tax, Ken.
Yeah, it's a slightly more complicated methodology in that you've got to get a valuation of the property at the time of leaving, but you get the benefit of that capital growth over that 6 years as part of the overall tax-free component. So there's a couple of steps that you need to look at, but in simple terms, that 6-year period would be tax-free.
Now, granny flats is not a property investment strategy I believe in for lots of reasons. But having said that, I know some people do in some states build granny flats and rent it out. And what happens then to my capital gains tax exemption on my home if a few years later I choose to sell the whole property, which clearly now has a granny flat on it?
So similar type rules as subdividing. It means you don't need that component of the land for your home. So proportionately to the land that is attributable to the granny flat would be taxable on the eventual sale. But one of the things that a lot of people ignore or forget is if that is a reasonable size of the total land, that could bring land tax into the equation. So there could be a proportion of that total land which is now subject to land tax because it's more than an incidental amount.
Interesting. Now, what about if I use part of my home for a business and suddenly claim electricity and a portion of the rates because I work from a home office?
The use of consumables won't reduce the tax impact of the main residence exemption. But home occupancy, where you're trying to claim part of the ownership costs, so the interest on the debt, etc., would be would reduce the taxable component. So if you're just using the home as a home office where you're only claiming consumables and not really earning an income from that, so you don't bring clients in, then you retain the full main residence exemption. But as soon as you use part of the home for income producing purposes and or claim part of the holding costs, then that proportion of the property would be taxable. So a lot of clients ask, but what happens if I bring a tenant in to use one room? So proportionately that room would be taxable, but then you've got to say what proportion of the living areas, the lounge room, the bathrooms, the backyard, is allowable for that tenant to use. And it's obviously something. So you've got to calculate what proportion of the total is effectively being used to produce income. That proportion will eventually become the percentage that's taxable on any capital gain on a sale. So the calculation can be a little bit complicated. So make sure you go to a good professional property tax specialist to actually make sure that the calculations are done correctly. Can I say to minimize the tax that you have to pay? Because in a lot of instances, I've seen that calculation incorrectly done.
Well, clearly the advice that you've given is general information because we don't know the people who are watching this or listening to this, their own personal circumstances. So you're right, get advice from a qualified a specialist. And who better than you, Ken Race, Australia's leading property tax strategist. Of course, you should always keep records relating to your home, to what you've done if things change, so you don't pay more tax than necessary. And why not have a chat with Ken Race at Metropole Wealth Advisory? The website address is on your screen at the moment. And Ken specialises in helping you grow, protect and pass on your wealth, get the right structures in place and minimise, but legally minimise your tax.
Yep.
Thank you so much for your time, Ken.
Thank you, Michael.